All right, everybody, welcome back to the Cashflow Chronicles. Today, we're talking about a topic that is definitely near and dear to my heart. And I know Chris has a lot of charts and stuff that he wants to share with respect to this. But for those of you guys that don't know, I work in oil and gas as a petroleum engineer. And so I kind of help with production in deep water Gulf of Mexico. But I think what a lot of things, while I love the finance junkies, I think they talk very negatively about oil and gas, and I don't think that that's a bad thing. I think it's an not an or conversation with respect to having oil and renewables and natural gas and all these things. But I think that the lens that is painted a lot of times, especially on the media these days, is specifically focused around renewables and how they'll save the day. But I think if you really truly look into the data, we still use about 100 million barrels of oil a day as a globe, and we also use about 21 million barrels last year on an average daily basis in the United States. And so I think that there's going to be a lot of just initial sort of reactions that you might have by looking at the charts that we're going to share with you today. We're going to go through oil demand and what the kind of prices are and stuff of the like. And then I'm sure Chris will have a lot of stuff to add as well. But yeah, I think that sharing this is something that we just take for granted, and I think it needs to have a little bit of a spotlight shown onto it. So, Chris, any thoughts before I start jumping into some of these charts?
Yeah, I think the first thing that we just need to clarify is that, you know, we'd like to imagine an environment where we didn't need to use fossil fuels, that everything could be run on renewables, but there is still not enough energy density in some of the other renewables that are coming out that can make up for the difference that we currently already use. So, a lot of times people think that it's going to be an easy process where we can just transition away from fossil fuels overnight. And, it's going to be a multi-decade process. And on top of it, you also have like the developing world coming online and actually using fossil fuels because that's how you industrialize in order to modernize their economies and bring themselves up. So the thing is, the demand picture is not as simple as we, as a fully industrialized company, we can probably detransition a little bit, but you got third world countries and even some second world countries starting to get to a point where the quality of life that is expected of the government to provide them relies heavily on the availability of fossil fuels, in particular natural gas and oil. There's been some diminishment in terms of like demand for coal because coal is definitely the dirtiest source of energy production that's there because of all the sulfurs and all these other chemicals that come along with it that actually do have a severe negative impact on like on the environment. So in terms of like dirtiest fuel, coal is probably the dirtiest. In terms of cleanest fossil fuel is probably natural gas because natural gas is just a combination of carbon, hydrogen, and oxygen in different proportions. And when you burn it, it just returns back to its original form, which is going to be carbon and hydrogen for some of the hydrogen and oxygen, right? And you'll be able to unlock that fuel source. So petroleum is the most convenient way to transport energy from point A to point B. I know a lot of people have like mixed thoughts on batteries being the future, and I agree. I think battery technology is severe, like improving at a scale that no one could have believed. But even so, the amount of energy density that's in natural, what do you call it, in fossil fuels is one of those things that's going to see it be a fuel source for at least another decade to 2 decades, So
Yeah.
yeah, and then we can go on and talk about that. So I just want to highlight that one thing is, if there are people telling you that oil and natural gas are completely dead and that no one uses them anymore because you got an electric car, dude, even your electric car is powered by the natural gas power plants that are generating the electricity to put it in your car. So you just went from filling it with petroleum to filling it with natural gas in a different format, right?
100%.
So even the people that think that they're like going super green by going electric, like, yeah, eventually maybe most of our electricity would be generated by renewables, but it's not there yet. And the likelihood that, believe it or not, you actually may be powering your electric car with coal and you may not realize it because coal still makes up a significant portion of our electrical grid. So
That it does. Yeah, we
yeah,
can definitely get into that another day because I like the topic of nuclear as well, and I think that a lot of
yeah,
times we skip over that, especially what happened with Fukushima back in Japan in 2012. I mean, Germany almost outlawed the entirety of using nuclear as a whole, but France does a really good job using that. But I think you hit a nail on the head there, Chris. And I think another perspective to look at it is this is something, the petroleum products have been something that we've been utilizing since the mid 1800s, since it was discovered in Titusville, Pennsylvania. And some people might say, okay, it was discovered in the Middle East or what have you, but let's just call a spade a spade. In the 1850s, 1860s, this was kind of the main kind of revolution. Otherwise, you'd have to use whale oils or something of the like to truly get to the same effect. And so this industry, this transportation, this infrastructure has been set up around the past 150 to 175 years. And you have to recognize, even if we are going to transition to some sort of renewable energy, whether that's offshore wind, onshore wind, solar, or any sort of biofuel, that infrastructure has to be made up over the next, say, 20, 30, 40 years, and it can't happen instantaneously. So let me just start sharing my screen. There's just a quick look specifically at how much global oil demand has grown. And this is starting from 1999 to about 2020. And I have several graphs here that kind of display different time periods, because obviously I want to zoom in a little bit. But you can just see it's pretty steady, 1.5 to 2 million barrels a day. There are times during, say, recessionary periods where you see slight dips. But overall, up and to the right, going from about 75 million barrels of usage a day about 23 years ago or so to now, I think we're over 100. And so scrolling on to the next sort of chart here, this is zooming in from 2016 to 2022. The barrels of oil usage here on the left going from about 80 is this sort of second to bottom line here, all the way up to 105. And you can see a pretty steady increase from about 95. And there's two lines on here. There's the actual production, which is the supply, and that shows up in blue. And there's the actual demand. And this is really important, especially when we start talking about price and how it fluctuates. You can start to see how much globally is building and kind of drawing down when we start talking about strategic petroleum reserves and stuff like that. So this is kind of on a global scale, right? So the United States might be using some SPG, but China might be building, right? So you have to kind of think on a global scale, this is what really happens. And because oil is very, the shipping trades have been around all over the place. People are using oil from Canada. We're shipping stuff in from Saudi. We're shipping stuff in from Venezuela. We're shipping U.S. oil to different countries as well. All because different oils, just like natural gas, it's a fraction, it's a hydrocarbon, right? Different hydrocarbons have different uses, right? So tars, plastics, all these sorts of things can be refined into different products that we have. And so different oils, depending on the maturity, I don't want to get too much into it, but depending on the maturity, can be useful and easier to refine for certain products. But anyway, going back to actually what we're talking about, here you can see what happened in the pandemic, a massive drop off in consumption going down to 85 million. I think this is when everyone was starting to say oil's going to zero. Oil prices went briefly negative in 2020, March or May of 2020, I forget which one, to negative $28 a barrel. I think Brent stayed positive, but WTI stayed negative for a few days until the contracts moved to the April month or to the May month. I forget which one it was, but you can see it rebounded pretty quick. And moving on to the same chart, but just looking specifically at 2021 to 2023, this is kind of on the back end of the pandemic, with demand being in this yellow. You can start to see a huge undersupply. And I think this is something that we're going to talk about a little bit. And an increase once kind of 2020 started ramping up again, everyone started to get back to work and oil prices started to increase. Everyone started to drill, and the demand and supply started to even out a little bit and got to the point where we're actually had an oversupply. And that's kind of where we've been in the past few months. And then I think people started to recognize now, we're getting to this point where we're undersupplied again because of what kind of has happened with oil prices kind of lagging and stuff of the like over the past year, and people being more capital conscious from a company perspective, they've gotten burned so much in 2014 and 2018 and 2020 to recognize this slow and steady, might be the way. Instead of taking on all this debt, instead of being able to have free money to be able to go out and develop all these reserves, we're more likely to watch after our pocketbook. Money's no longer free. And really have to balance the books a little bit better than what happened in 2014, 2015, and 2018 when a lot of companies went bankrupt. And so the last thing I want to highlight, and I'll kind of go back to this 2016 to 2022 chart that kind of shows the supply demand. You see periods of oversupply, you see periods of undersupply, and that all coincides with what this ends up looking like. I think a lot of people assume that when the oil price goes to $20 a barrel, that there's this like an affluent amount of oil circulating around the world. And when the price goes really high, there's this massive shortage. And it's really not true, right? I think if you go back to what we're looking at here, this is literally on the right hand side is the supply and undersupply, or the deficit, I guess, if you want to call it better, of the supply demand curve. You can see that even back in 2021, we were only really undersupplied by 2 million barrels a day. And when we go to oversupplied, it doesn't even get to a million. Sometimes it gets to 2 million barrels a day. And so to see the spikes that we're having, right, and it going from, this $28 a barrel, let's just call it, or basically zero, to, I think if we zoomed in here, it'd be a lot higher than this, but $120 a barrel by the time you get to mid 2022, and now kind of back to the $80 time frame, or $80 a barrel right now. You kind of see there's not a lot of ups and downs, right? We're talking about fractions of like a percent that truly manipulate this. And I think that this feeds really well into what I think Chris is going to talk about. So while I kind of laid the framework for the next 20 minutes or so, Chris, I'd like you to take over and
Yeah.
give us a thought about what you think.
So the others. So that was a good explanation. Now let's talk about the other side of it, which is how do these oil and natural gas companies, how do they account for all this back and forth, right? Like sometimes it's overly expensive, sometimes it's underpriced, right? So how do these guys do it? Well, this is why you have these market cycles where there's going to be over investment in the sector and then under investment in the sector. And so I got caught up, and this was like one of my biggest losses earlier in life, which is that I was in the market for so long because I was doing exceptionally well with energy that I thought that this was a great trade to be in. Right, one of the highlights of in the early 2010s, post 2010s, was oil and the US has predominantly a very energy rich environment in Texas, Oklahoma, Louisiana, with regards to a certain type of oil that you can extract called shale oil. Now, shale oil is basically trapped in rocks. Just think about, oil just trapped in the rocks. This is not your traditional like pools of oil that you would find in something like the Middle East or the Deepwater Gulf, where they actually have large amounts of large body of water that's been concentrated under the ground that you can just extract. So these are oils that are in the rocks that prior to Pioneer, I think Pioneer was the first one to successfully do a process called hydraulic fracturing, right? Where basically you would send a tube down, you would actually explode the rocks. Once you exploded the rocks, you would put a chemical reagent in the fissures, right? And that chemical reagent would then loosen the oil, and the oil could then be extracted back up back up to the surface, and then that solvent can be removed, and then it could go back down again, and you would be able to basically get oil out. So oil and not the oil industry is probably by far one of the most innovative companies in the world, because there's a huge incentive to make things work. There are untapped sources of oil and natural gas all over the world, even today. I remember a lot of news reports prior to the year 2000, 2008, 2009, that the world is running out of oil. And the truth of it is, no, there's plenty of oil. It's just that the cost of getting that oil is much harder if you don't innovate yourself on how to do it. So another example is Canada. Canada actually has a lot of oil, but it's all in tar and sands, right? So to actually get the oil out of the sand requires a process that's actually that's very expensive. So it's just one of those things that you have to contend with. And then even among the oils, there's different qualities of oil. The best quality of oil for production of fuel comes from the Middle East. That's called Brent, not Brent. What is that thing called? Is it Brent? What is it called? Or Murban? I forgot the exact term for it.
There's a
The
bunch of
one that
different.
comes from, yeah. So basically, it comes from the Middle East. It's something called light sweet crude. Light sweet crude is basically, it's very light. To get gasoline from oil, all you really have to do is just heat it. Once you heat it to a certain temperature, you're going to get different distillates, and then you would extract those distillates out. Those distillates can get refined into different products. Usually, it starts off with gas. I think jet fuel, gasoline, so on and so forth. Then diesel, and then much further up is like waxes, and then and then different things you get, and then eventually you get a product that we use in the roads for servicing. But essentially, light sweet crude is probably the best when it comes to production of fuel. It's also like concentration of sulfur that's in there as well. So if you look at Venezuela, one of the largest deposits of oil in the world is actually in Venezuela. But the oil that they have there is something that's a lot more dirty. It's like something called sour
Sour.
crudes.
Has a lot more
So yeah.
sulfur into it. Yep.
Yeah. So in order to actually extract that oil and refine it to petroleum, it actually requires a much bigger process, and it requires specific types of refineries. Those refineries here we have in the U.S. So everyone thinks like, oh, we could just pump more oil and everything is going to be okay. It's like, no, you have to not only pump the right type of oil, you have to pump it in the right location, and you have to do it at a price point that actually works for people. So my blunder in oil was thinking that oil was always going to stay, because of a natural deficit, was going to stay at a high price, and that these shale drillers, it used to cost them $60 to $70 a barrel, but if oil prices at 100, they're still making a $30 to $40 margin per barrel, which is great. It runs their business. The problem is when the prices drop below that amount, all these companies were left with oil that left with production that wasn't making the cash flow. So what do you do in the meantime? So basically, some of them had to go out of business because they couldn't support their operations.
Mhm.
Some of it was actually the cause, some of it was actually due to OPEC and the cartel that they have, because they wanted to break the American shale industry. So what they did was they actually just increased their production like crazy. The amount of production that's in the Middle East that's actually tapped and untapped regularly is what actually balances out the oil markets. So at the time, the Saudis and the Middle East and the OPEC wanted to basically bankrupt the U.S. shale producers. So they thought, hey, let's just lower the price of oil by pumping a ton of it, and then these guys will get out of business and they'll never come back. Unfortunately, America is not that type of country where you're just gonna sit back and watch us fail. We'll fail, and then we'll fail again, and we'll fail again, and then we'll fail again until we get the shit right. And so look at right now with the US production of oil right now after 2010s, after the invent of shale, it's just been gangbusters, right?
Right.
So the US is still one of the most innovative companies on the planet. And we are actually one of the largest, if not the largest producer of oil in the world right now.
Yeah, it
It's just
goes
that,
back and forth
yeah,
between Saudi Arabia, Russia, and the United States. And I know we took over briefly in 2019 as the largest producer, and then with everything that happened during the pandemic and the choke back and companies kind of closing the chokes to make sure they're not producing at negative rates. Um,
yeah,
I think that Russia or Saudi took over again, and I think we're back as either being number one or number two. But this is kind of what Chris is referring to. So I wanted, Chris, you did a really good, eloquent job explaining, hydraulic
yeah,
fracturing and stuff. The rocks don't actually explode, and the better way to kind of look at it is, um, you know, all rocks are coming, or all oil is coming from rocks, right? So whether or not
Mhm.
you're talking about big, like if you were to pick up a sponge, right, it shows up as a solid piece, but there's holes within it. And so if you think about sandstone, I mean, that's pretty much what it is. It's all just kind of cemented together. There's pore space between everything, and you can have things that have up to 38% space, or porosity is what we call it in the industry, or in the case of the shales, which Chris is talking about, in an 8% or 7%, porosity. So think about if you were to hold up a sponge where you see all the holes and it's very visible, and you put that up against a rock. That's kind of the example that Chris is kind of showing. It's like, well, you can have water or oil or whatever you kind of want flow through the sponge really easily, but it's not going to flow as easily through that rock, right? Whether that rock's a shale or a sandstone or what have you. And that's kind of the difference, is what Chris is kind of talking about when he talks about the shale oils. And you can see that the revolution really truly started in the late 2000s. And hydraulic fracturing was kind of an experiment done in the 40s and 50s, and horizontal drilling is something that's been around for a dozen or so decades of years as well. But I think it wasn't until we started to drill sideways and do multi-fracturing technology, multiple stages of fracturing, which is basically just overpressure and then forcing conductive sands into the rocks that you break apart. So it's not exploding the rocks, but in the simplest rudimentary form, it's kind of what you're trying to do. You're trying to induce a fracture within the rock to put more conductive material in there so that it flows easier to the surface in a controlled manner, of course. So you go from what we were kind of relying more on the OPEC in the late 2000s to the point where we're actually becoming self-sustaining. And a lot of this had to do with, just making sure that things in the Gulf of Mexico were up to speed, and Permian being discovered, and many other places as well. And I'm sure if you looked at natural gas is probably very similar. We've got to the point where, and I think this might be something that's important, and then I'll hand it back to Chris as well in case he has any other things to talk about. Before I actually move on, shout out to Amit and Hot Dave in here. Hot Dave is my buddy that is retired, and I've been trying to get a hold of him for about a year, and he's been avoiding me. So Hot Dave, what's going on, my guy? But the LNG terminals that we had in the Gulf Coast, as well as the East Coast, and even some that are planned now on the West Coast of the United States, and even Alaska, there's one planned.
Mexico too.
And in Mexico,
Yeah.
those were all planning to be, well, I don't know how much, if Mexico is planning to be an importing terminal, but all those terminals in the United States were planned to be importing from Russia, from other countries, because we just didn't produce enough natural gas. But here we are now in this world of shale and understanding how to develop those resources. It gets back to Chris's peak oil sort of thoughts. The ingenuity of these drillers and what they're doing, and understanding how to develop and get the hydrocarbons out of the rocks in a safe manner, really unlocked the United States to turn those import facilities where we've been importing from Russia, just like Japan does, China, and a lot of other countries import from Russia. We were planning on doing that, kind of in the late 2000s, early 2010s, until we discovered how to actually get the gas out of the rocks. And now we're actually the ones that are exporting. We were exporting hugely into, I know we do a lot in
Europe
and
and Japan.
as well as Japan. Japan has a really good deficit for us, where we're actually able to take it at $2, $3 per MCF. And at some points during the war last year, we were able to send it to them for $40 to $50, maybe even more per MCF. That's what the delta was. While we were able to get it here for like $6, $7, $8, which was expensive to us. We haven't seen those prices since the late 2000s. That's like cheap to them. I think they're still at like $13 or $14 per MCF.
Yeah.
So that margin, and I think that that's something you're going to continue to see. And I'll hand it back to Chris. The oil price, because it's so easy to be moved and it's a liquid rather than a gas form, the differentials is relatively, not that much, 20 to 30%. Versus, for, let's just say, a price in the United States versus a price in like Canada or something like that. And a lot of that has to do with grades. And I pulled up the oil prices at all the different grades that we're showing earlier. You have West Canada Select, you have the Murban, which was Chris was talking about, Brent. All these different things have different qualities to them, whether it's sulfur, whether it's the actual hydrocarbon content. Are they heavier? Are they lighter? How easy is it to refine? That sort of thing. Versus LNG or natural gas. In the United States, it's so abundant And it's not easy to just put in like a barrel, like you would think, or a tank and just move it. You have to actually freeze it down to like
Mhm.
negative 200 degrees or even more to be able to get it to shrink to 1/600th of its size and put it in liquid form. Think about putting a gas in a liquid form, how much work that has to do, those LNG trains have to do to compress and freeze that, put it into a ship, and then move it across the world. So it's a little bit more difficult, and that's why it's a lucrative commodity at the moment, and why Japan is kind of stuck between a rock and a hard place because they're literally on a huge island, right? There are, you don't think of it as an island, but it's a huge island on its own, massive island, but they don't have any reserves that they can produce themselves, or if they do, it's very small. We don't talk about it as much, but that's why Japan's always been a huge importer of natural gas. But anyway,
Yeah, and there's actually countries in the Middle East that actually built their entire economies just on natural gas. The greatest example of that is Qatar. So Qatar doesn't have as much oil and everything else, but they had an abundant supply of natural gas. So their leadership way back in the day actually made a lot of strategic investments in export capacity of liquid natural gas. And at the time, it was like, oh, do you really need to? But he really took a serious bet on it, and it ended up being really well. And right now, Qatar is actually one of the largest producers of liquefied natural gas. And yeah, and they're routinely sold out all over the world. I just want to show people something really quick so that it distinguishes between the two. I'm gonna go back to LNG, which is the company that's very interesting with regards to
God, don't
LNG. But
show me that, man. Is that LNG the ticker?
the Cheniere. Yep, Cheniere.
Don't show me that, man. I used to
I know,
have.
I know, I know, I know.
Oh my
Trust me,
god,
I had
I
it too.
hate
I had it too.
myself.
Don't cry. Don't cry. I
Oh
had it
my
too, bro.
god. Sorry. I try to be not emotional, but Jesus Christ.
Yeah, me and Matt are probably both crying right now for the same reason. We both had this. We'll explain in a little bit. But basically, whenever you see ships like this is an LNG tanker. Okay, when you look at an LNG tanker that's usually has these things, that's where the liquefied natural gas is actually stored. And if you look at just the regular oil tankers, this is what a regular oil tanker looks like. It's just flat. Usually, a lot of the surface body is under the surface, and basically all the oil is transported that way. So if you look at it on a relative size of ships, they're actually some of the largest ships in the world. So if you look at the USS Enterprise, which is the largest aircraft carrier, Allure of the Seas was the largest cruise ship, they're significantly larger than that, right? So these things are floating all over the world at any given time, basically making the modern economy work. Um, Now, I will go back to LNG. This is where some people, one of my buddies, he still has 100,000 shares of fucking Cheniere. Okay, never sold it. Even after Suki got fired, because that was, I'll explain Sharif Suki. He's probably one of the guys that changed this entire industry. And you guys probably never even heard of him. But basically, Sharif Suki was one of the principal people in the liquefied natural gas world, where at first he wanted to import natural gas from other parts of the world into the United States because we were using LNG until we discovered that we had a lot of LNG. So Suki at the time in 2008 quickly pivoted, and let me just show you guys what this looks like.
So to give you guys context while Chris is pulling that up, I used to own LNG, the ticker symbol, I think in the 2015, 2016 timeframe, and I made a couple percent, right? Now I had a small positions back then, 2015 to 2017, a couple $1,000s was a lot to me. So I think I made like 30 odd percent and called it quits.
So this is the stock LNG, which is Cheniere Energy. One of the founders of it, his name's Sharif Suki. This guy right here. Basically, at first they wanted to import LNG into the United States. Turns out, actually, we had a lot of LNG, so we could actually export it. So at the time, everyone got super excited about this. So they ended up really going ham. And this is the 2010s where they flipped the script, and Then everyone started to get really excited. Everyone was putting money in LNG, the company, and then the trains were still delayed. It takes a really long time for these things to produce. And eventually it didn't do well. It dropped off, and they had a giant board fight where Carl Icahn actually came in and fired Suki. Basically, got him off the board of not just off the board, but basically out of company itself, and put in Jack Fusco. I think, yeah, Jack Fusco, who's the current CEO. He's been the CEO since 2016. So you can see around here, 2016. And Jack Fusco has actually been able to complete all the projects and everything else with Cheniere, and they have been one of the most prolific exporters of natural gas here in the country. And if you see how much money that these guys are making right now, it's close to $5.4 billion in net income last quarter. And you can see here basically all the growth that they've had since then. And right now, their PE is actually, even at a price of $158 a share, it's still only 5, which is kind of crazy, but that's how it is, right? The problem with the problem with energy is sometimes that fluctuation of overcapacity and undercapacity can scare a lot of people into not investing. And so investing is all about consistency. And because you don't have consistency, sometimes you can get shaken out very quickly. Um, but I don't know, what time frame did you own LNG?
I'm trying to remember. I feel like it was after the drop off because I don't
Yeah.
remember selling at a loss.
I sold at a loss. So I had it around here in 2014. And I was like, okay, these trains are going to come. And then there were delays, blah, blah, blah. And then when Carl Icahn took over, I ended up buying back in again. And then I unloaded in like 2018 because I had lost a lot of money in some of the other companies that I was invested at the time because oil had gone down so much. But had I held LNG, it would have been much higher position right now. And this is a company that's cash flowing like crazy. And what's interesting is now you're starting to see construction like across the United States. There are tons of projects coming
Yeah, East
online.
Coast. Yeah.
Yeah. And the one that and there are some companies right now that I'm sure that I'm going to bring what's his name, Steven from Dividend Streams on here, because he invests heavily into the sector, that are close to getting to the point where the construction is being greenlit for production. So what happens is the lead time that it takes, it usually takes a lot of capital financing to build these trains. But once you get the approval and the banks to finance it, it's actually not that hard. And then eventually, once you start exporting, it's like a giant ATM,
Hmm.
literally just printing money. So if
Hmm.
you can get into that stock at a very early point in its life cycle, you could end up doing, like, I'm talking about not 10x, 20x, I'm talking about 1000x, which is unheard of, right? But it is possible. One of the companies that could possibly do that, and maybe we'll talk about in the future, is Tellurian. But let's save that for another time.
Isn't that
But
a co-venture between Duke and somebody else? I forget who.
no. Tellurian is actually Sharif Suki Part Two, where
Okay,
he
I've
ended
fallen
up
off.
taking a lot of executives with him from LNG, from Cheniere, and now they're doing a project in Louisiana, I think St. Charles. So they're actually building an LNG facility there. They have approvals. Bechtel's already doing the work on the site, but they have a problem with financing because no one's willing to finance it right now.
Can you remind me? Is CQP LNG Partners
I think
or
so. Let me just
okay?
look.
I own
Cheniere Energy Partners.
CQP.
Yeah,
I own
yeah,
CQP. I
yeah,
didn't own LNG. So
yeah,
if I don't remember what the ticker and how well it was trading, but I remember owning that
yeah.
because it paid a dividend. I don't know if LNG pays a dividend yet, or is it
It does, but
still
it's very low. But it's very
okay?
low.
Because I know CQP did, and that's a master limited partnership, and I think they had an interesting organization structure. And I think CQP at the time was building the Corpus Christi facility, not the Sabine Pass.
Hmm.
And it was owned under that. And so I wanted to make sure because was late to the party for the Sabine Pass. I think they already sanctioned trains 1 and 2. And I think I bought CQP because they had just kind of greenlit the Corpus Christi. And I don't remember Yeah, I'll have to look it up. That's a really good
Yeah.
point.
Yeah.
This gentleman, Jackalope, brought up, he wanted to know pretty much what, and this is the US. So looking for what the petroleum in the United States is. And this is kind of using 20 million barrels a day. So you can see a pretty large fraction of that is associated with transportation. So about 44%, or about you know, two, sorry, 1 gallon, sorry, 50% of every gallon of oil, or half of every barrel of oil, goes pretty much to the actual transportation fuels that we use, distillate fuel oils, and then you actually have gas liquids that help in there as well. But the other third of it goes to industrials, so things like jet fuel, things like tars, plastics, stuff of the like. And then you have a little bit that not a lot of oil goes to consumer power. It used to go from coal. Coal was pretty much the primary use of oil. Coal was pretty much the primary power that we use in the United States throughout the 1900s, and then it started transitioning to oil. And then with the abundance of natural gas, we moved a lot of coal and oil power plants to natural gas because it is cleaner. It's the cleanest fossil fuel, as Chris kind of alluded to, because it's only one carbon chain, or two carbon chains if you use a little bit of ethane. But then yeah, now we're starting to get to the point where we're relying less and less on oil specifically, and more so on natural gas for power plants. So this is a very small percentage, 6%, only being used for electric grids, which makes a lot of sense.
Yeah. Um, One of the other things is when you are looking at the oil and natural gas sector, there's the different areas where you would typically invest in. So not everything is just investing in the up what do you call it,
Upstream.
the upstream portion, which is like the Exxon Mobil's of the world. There's other portions of it that are actually very profitable and actually have a lot more consistency, and actually could be a very good way of generating income. So I'll give you some good examples. One is MLPs that are specifically geared towards the pipes that
Mm.
actually transport this stuff all over the country, right? So there's actually when you have like a pipe, most of those pipes are actually owned by select companies, and that's actually like almost like a toll bridge, where if you produce oil in your specific area, you're going to have to put it on a pipe and send it from location A to location B, and they actually charge you for that, right? So the people who own the infrastructure, they actually get paid to do that. So that's one sector to invest in. LNG is the same thing, where you actually have companies that make their money by doing the liquefaction process, and then they'll actually work with the shippers to ship it all over the world, but they get a fixed amount of money regardless whether or not the price of oil is 100 or 50. These are yeah, and this company right here is actually one of my favorite companies to actually, if you are trying to look at producing some sort of like dividend stream. Kinder Morgan is a very well-run company. By the way, did you know that Kinder Morgan is actually one of the principal partners for a project here in Georgia, in Savannah, for I think for an LNG facility. So and there's other things. There's other things that this company does that actually helps produce oil. One of them is they actually take CO2 and transport it to the oil fields to do something called enhanced oil recovery, where basically there's certain oil that you can just naturally just suck out of the ground, but then also you can actually pump carbon dioxide down there and actually get every last bit of it out, and that marginal amount that you get out can actually be substantial amount of profit for that. So these guys actually provide the piping that actually helps with the CO2 portion as well. That business has fallen off considerably, believe it or not. It used to be a much larger part of their income stream, but it's still there. But
The
basically, they own
CO2,
the
or you
pipes.
mean
Yeah, the
yeah.
CO2 portion, the CO2, because they have to sell the CO2 to do that. But essentially, their natural gas right now is their natural gas pipelines are just all over the world. I mean, all over the country, and they're very stable. Yeah, they're really good, and they've been consistent dividend players. dividend payers for a long time. The only thing that I would say is a little bit like not so good was that they converted their well, I mean, it's good now, but it sucked for a lot of longtime holders of KMI, where they actually changed their tax from an
I got caught
MLP
up in that.
to a C corp, and then everyone had to pay a shit ton in taxes. And so these are the things like you have to be really like nuanced in. But now this is just a great company that if you want to just sit back, relax, collect some nice dividends, not have to worry about stock moving up and down so much. It's a consistent dividend payer. So
Yeah, I got caught up in that, and I think I got like a $700 check because of what happened. They cashed me out of the one and they moved me to the other. But then as soon as it moved, like you said, it wasn't being valued as an MLP anymore, and so it
mhm,
started being valued because it was valued on distributable cash flow. And so everyone
yeah,
was like, "Oh shit!" The stock price was up high. Then it merged, and then it wasn't being valued as distributable cash flow anymore because they weren't getting the tax benefits. They were being more evaluated as a C corp. And so the share
mhm,
price tanked and I got screwed. And I think eventually I
yeah,
broke even on those shares, but um,
yeah.
it
If
did
you wanted
pay
to
a
share the
dividend.
screen.
Oh, yeah.
Right here. This is what happened to it. So basically KMI had flipped around, and you see this precipitous drop. This is how oil and natural gas is, baby. That's how it works. If you get in at the right time and at the right price, things are amazing. And if you don't, you could get dicked over pretty hard. So that's why you just have to know really what you're doing. It's actually a sector that you can make a lot of money in.
Hmm.
It's like I've seen multi-mil. If you go to Texas, half of the millionaires in Texas are still like oil barons from back in the day. And it's not that they own anything. All they do is they own the ground, and they sell the leases to these companies who actually do the production.
And they
So
give them
that's
a
where like a
royalty.
lot of
Yeah.
people, and they get a royalty for it. So royalty is another place to look at, because there's actually companies that own large mineral rights that are able to generate return from that. Then you have, of course, Baker Hughes and Schlumberger, which are oil field servicers. So they actually provide the equipment to actually service the companies that are going to provide the oil that goes up. Then you have providers of offshore rigs, like a like rig. I forgot the company that what's the fucking name
Transocean.
for it? Huh? Transocean.
Transocean,
Tra-
Diamond
huh?
Offshore, Seadrill, which I think Seadrill merged.
Bankrupt.
Yeah.
Did it? So,
Merged with
but
somebody.
but let me tell you, the best value proposition in history of oil and natural gas, Matt, that I missed on was
I thought you were going to tell you about your corporate bond.
this one was a corporate bond play, but basically what happened was everyone thought offshore oil was dead. And
Mhm.
so one of the things that happened with Transocean was likely candidate for bankruptcy, but they were able to survive. Their bonds were trading at like pennies on the dollar. I'm talking about 1 to 2 pennies on the dollar. You could have bought them for like 10 cents. Each one of those bonds right now is worth at almost at par, and there was about 7 8% coupon per thing. So you're talking about a capital appreciation of 1,000% on just the bond itself. And based on your initial capital, you're getting paid 70 80% per year on those bonds, technically. So you could have, think about it this way, you could have paid $1,000, and every year you've got a $700 check. And that $1,000 now is actually worth $10,000. So these are kinds of things that, like, if you are able to figure out and digest and get in at the right time, could literally set yourself up for decades of prosperity.
Mhm. Yeah, no, I think while everyone was selling and talking about oil going to zero in 2020, I was buying up a lot of Shell, Exxon.
Hmm.
I get some shares through work, but I can't really talk too much about that. But yeah, I think through then I was buying a lot, hand over fist, of banks and oil because I knew that those were both
Hmm.
going to rebound. And I sold Exxon a little early. I think I sold it in the 90s, 95s, but I was buying it from 50, 60, I think is when I first started buying, all the way down to the 30s in 2020. And I was like, there's no way this is not going to turn around. I was like, they have Guyana, they have all these low cost positions and cost bases that they have around the world, and they're continuing to consolidate. For a while, I think a lot of people are giving Exxon a lot of heat because they were running at a large deficit. They were taking on a lot of debt. One, so they could accelerate what was going on in Guyana, and two, they could accelerate the Permian. Now they have massive positions in both with low cost bases, and they've sold off a lot of their other projects and are mostly focused on those two places. And it's turned out handsomely for them. I'm going to mess up the wildcat success rate that they've had in Guyana, but it's been one of the wildest things that I've ever watched unfold. 2015, they had their first discovery. Now I think they're making about 700,000 barrels of oil a day, less than 10 years later. And they have another 2 or 3 FPSOs that are kind of in like the actual pipeline. But in terms of how much oil they have found to date, I think it's 13 billion barrels of recoverable, not in place, but recoverable oil. And Hess has done a really good job. The fact that nobody's bought Hess yet is pretty surprising to me, because Hess mentioned specifically that for every FPSO that's out there, to which now there are 3, and there will be a 4th, I think, starting later this year, or early next. And I think they just sanctioned the 5th. For every FPSO that is out there in Guyana, Hess mentioned that at $50 or $60 a barrel, they will be getting $1 billion in cash flow. Sorry.
Not to interrupt you, but FPSO means floating production and storage. Basically, these are the rigs that you put on the site to actually extract the oil. Sorry, I just wanted to. You said FPSO. I just wanted to.
No, sorry. I appreciate that, because like normally when I talk about oil, I'm literally at the office, so it's like everybody knows what I'm talking about. But I think what Chris was talking about with Transocean, I have a graph here that I've been sharing while I'm going off about Guyana, but 0 to 140 is the oil price on the left, and this has kind of been normalized, I guess, for inflation and stuff of the like. 2010 to 2014 was a wild time. It's kind of when I joined the industry. I joined in 2013, so everyone was fat, dumb, and happy. And so what I observed was like everything was great. Lunch, you could always go to a lunch and learn and get lunch, and then next thing you know, the industry is flipping on itself, and oil price kind of goes down to the $28-$30 a barrel, and by the early 2015 timeframe. So the industry definitely changed itself, and exactly what Chris said. Everybody was like, "Oh crap!" Everyone was happy. Everyone was investing at $80 to $100 a barrel of oil, and next thing you know, everyone's legs are getting cut out from underneath them, and they're looking for the door. And those are the people that were heavily leveraged, because when you look at this, before in the late 2000s, oil was going up. It had a brief decline in 2008, 2009 during the great financial crisis, but it popped right back up pretty quickly in 2009 and kind of stayed there, continued to grow and grow and grow. But everyone and their mom, because the margins were so good, was getting back to oil and gas. And so with that, when you think about it, say you just get started and you're the first player in town, you're going to be able to call the shots. You could be like, Baker Hughes, Schlumberger, give me your best prices. Nobody's hiring them. But when everybody's hiring these people and the oil price is good, you might be starting off at $50 a barrel of margin. So you might be sitting there fat, dumb, and happy. But next thing you know, Bill next door wants to also use Schlumberger's prices. So what is that going to do? Demand for their services goes up. And next thing you know, your demand or your margin that you were getting was $50. Now it's 20, now it's 10, now it's 5. And then the oil price drops immediately. And now you're sitting there losing money. You're literally having to produce things at a loss because you have all these facilities and contractors that you have to pay and agreements that you're locked in for. So if you have the capital wherewithal, and this doesn't go for just oil and gas. We talked about it a little bit briefly yesterday. Oh, wow. Thanks, Wayne. Much appreciated, my friend. Really appreciate that. If you have these things in place for 2 to 3 years, next thing you know, you're stuck. And so that's where if you don't plan appropriately or hedge your production, which some of the smaller players do, they go belly up. And that's what Chris was kind of talking about with Transocean and a few of the other players that he had bet on back in the day.
Let me just show you guys something real quick. This is the bond that I missed buying because I was a little bit of a chicken shit and I had lost money earlier in life. But this by far was one of the craziest investments that you could have made. This is Transocean's bond for 2041, and basically it pays a 9.35% coupon. Okay, that's the price that they pay you every year for owning this specific bond. Now, when you buy a bond at a discount, they're still going to pay you the 9.5, but it's based on the face value of that bond, not based on the current share price. I mean, not the share price, sorry, current price of the bond itself. You could have bought these bonds at literally like 10, 11, $12 and just sat and just relaxed. Those bond prices now have gone all the way to 80, right? So you would have 8x your money on the way up. But what's crazier is that you're still going to be getting that 9% coupon based on this right here. So imagine right now $1,000 you could have taken, put it in here, bought up, let's say one bond. So it would have cost you $1,200, right? That bond right now is worth $1,000, which is amazing. But what's even better is that every year you would have been getting $935 for an initial outlay of only $1,100. And this is purely just coming in. You don't have to do any work. It goes right into your account. It gets dropped off right into your brokerage. And you just, and the other thing is it's actually super, super secure and safe because it's actually backed by assets because there's actually things behind it, right? So I think a lot of times people just they look at equities and they only want to buy stocks. When it comes to oil and natural gas, you can actually buy some really good corporate debt because they're always looking to finance. And if you get it at a really good price, you can end up making crazy amounts of return. But once again, it's one of those things that you have to take a risk on. So I took on some unusual amounts of risk. It didn't pan out for me as well as I hoped, but I've been able to recover, and I'm always looking for opportunities where things have fallen down considerably. But I look at the company and I see, okay, what are they doing to correct the ship? What are they doing to basically mitigate any sort of disasters that may be coming? How are they hedged? Because that's another thing. Some companies, they don't hedge properly, and that's something that maybe we can talk about in the future, how hedging works in the oil and natural gas sector. Because some companies, they're very smart, they know what's coming around the bend, so they ended up hedging their bets, actually paying some money up front to say that we're going to be able to guarantee this price going into the future. And those companies tend to do very well. So there's actually companies right now that are excellent at hedging. They know how to hedge to the downside and they know how to hedge to the upside. There's a lot of times where companies will hedge to the wrong direction, where they'll actually buy a whole bunch of protection and then the price of oil goes so high and now they have to sell at a loss.
Yep.
And they have to take those hits up front, and it ends up showing up on their balance sheet because it's like you're thinking that, oh, the price of oil is $120 a barrel. This is great. The company that I own, they were only producing $70, $80 a barrel last year. That means their profits will be 10 times higher. It's going to be great. And lo and behold, when you look at their balance sheet, it's loaded on with these hedges that ends up costing them millions upon millions of dollars, which then impacts their profit. So that's where you have to have like a lot of good insights into companies, and you have to do a lot of deep digging into them and figure out what this company is actually doing. How are they hedging? Are they good at hedging? Are they not good at hedging? And yeah, so it's a very complicated field, but one that's super lucrative as long as you're willing to do the research and the due diligence. And sometimes you also have to look at how the macro environment is too, because the macro environment is very important to this sector. The minute that, like COVID, when that hit, there were companies that knew exactly what to do. They knew what they were going to do, how they were going to scale back. And there were other companies like figuring out, okay, you know what, right now, while everything is cheap, we need to goddamn buy up as much acreage as possible using excess capital that we have. And they're all making bank right now. Like Diamondback is just killing it, bro.
Mm-hmm.
FANG, FANG.
There was a few companies as well that were buying because a lot of people were laying down rigs throughout 2014 to 2020, and it's really got to the place now where things have kind of normalized and activity's gotten back to the Gulf better than I was expecting. But some companies, man, they're getting contracts at bottom dollar prices and stuff that you probably wouldn't have seen since like the early 2000s. But yeah, now it's getting to the price where things are the point where things are starting to get a little pricey again. And we're talking, oil went to, you have to think there's always lags, right? I was talking about the margins and how they shrink over time due to demand
Mhm.
and inflation. And you have to think the supply chain wasn't unique to food and stuff like that. It was expanded to steel, it expanded to oil field services. So things getting delayed. If you pay more, then we'll be able to help you faster, stuff like that. And that really puts a hamper on your margins kind of going forward. But I do like the fact that you talked about futures a little bit. Futures are important for not only the oil producers themselves, but people speculate on futures. And that's why
Mhm.
oil price went negative in 2020. So that's something we can talk about,
Mm.
because everybody was basically like,
Yep.
oh shit, I have to take delivery of this. I don't actually have any storage. And so they were like, I have to sell this at any price that I can because I don't have the ability to store it. Right.
Mhm.
Everyone
And
was
storage was
speculating.
expensive.
Yeah.
Everything was full. Everything was tapped full, so you couldn't even store it anywhere. I remember there were companies, oil LNG, not LNG, sorry, oil tanker companies. They were literally paid money to store oil and not move it. Literally, you would just store it and it would just stay in one place. And the day rates for those, holy shit, they were in the
Mhm.
hundreds of thousands of dollars per day,
Yeah.
which is nuts.
Same.
Ugh,
But anyway, it's a
yeah.
different story for a different day. But
Yeah.
Chris, I think we can end it there. I'm trying to think
Yep.
if there's any questions, but I'm trying to think. I don't know if we should discuss it live or not, but we have a lot of discussions tomorrow. I don't want to compete with the likes of Amit and FinTech Weekly. So I don't
Maybe
know. What do
next
you?
week we'll get back to normal. Probably
Yeah.
Tuesday, because Monday I'm gonna be in Mexico for my 5-year
Oh,
anniversary. So
congratulations, Cabo,
yep,
Cancun,
Cancun, Cancun.
Cancun. Cool.
So I'll see you guys next Tuesday
Maybe I'll
probably.
sneak and try to
And
find you in the resort. I don't know.
why not? Come on through, man. But yeah, I think what we'll do is one of the areas that is actually worth exploring right now is oil and natural gas. I think there could be some opportunities here in the next 6 to 9 months that are worth exploring as a hedge against the economy, because there's been such there's been a lot of underinvestment in the sector, and a lot of these companies are throwing off cash like this nobody's business, and their PEs are super low, which means that if there's a place that you want to hide during a recession and they already have a sector that's relatively, been beaten down, it could be a good place to chill out, get some returns, and you could just relax a little bit. So our
Yeah,
strategic oil reserve wasn't 100% full then.
I think
I
it's
mean, we
talking
could
about
talk about that.
2020.
Yeah.
Yeah,
Yeah.
cool. All right, man. We'll have fun in Cancun. When do you fly out? Tomorrow? Sunday? Saturday?
Tomorrow, no, Saturday morning. Saturday
Cool.
morning.
All right, man. We'll have fun.
Yep. All right. Thanks,
All right.
man.
Talk to you guys.
Well, like I said, we are definitely going to keep going with this. The only thing is, eventually we're going to drill down into like certain companies. Right now, we're talking very high level because we want to have you guys understand that it's not just a matter of picking a company and then investing in it just purely based on the price movements of the stock. When it comes to like the chart with oil and natural gas, throw that shit all out the window. Like, oh my God, this is 200-day moving average. But no, no, no. That stuff doesn't work.
Mm-hmm.
Okay. With oil and natural gas, you got to look way beyond the chart looks like this. And, there's very little, there's no like, what's the word? I'm trying to think of a word. There's no consistency in oil and natural gas like that. Like you have to figure things out and then see things that are coming.
No
And then you
direct
have to actually do.
relationship, I guess, is what you're
Yeah,
saying. Yeah.
exactly. There's
Cool.
no direct relationship to like charts. I know some industries you can like figure that out and saying, oh, this is trading at below its 200-day moving average, and that's why it makes it a good investment. No, with oil and natural gas, that shit goes right out the window. You know.
Cool. All
Yeah.
right, my guy. We'll have fun in Mexico. I'll talk to you next week.
Thanks. Later.
Cheers, man. Later, everyone.